Let's talk about Warren Buffett, the Oracle of Omaha, who built a multi-billion-dollar empire using just a handful of simple, powerful rules. Today, we'll break down his 5 golden rules for investing success, sharing the stories and mindset behind each one. Ready to learn the blueprint that made Buffett a legend? Let's dive in. Warren Buffett, one of the most successful investors of all time, has a simple yet powerful rule that guides his investment decisions. It's a principle that has helped him build his fortune and avoid countless pitfalls. That rule is, only invest in what you truly understand. He calls this your circle of competence. It's the boundary of your knowledge. Most people lose money chasing hype, jumping on the latest trends without truly knowing how a business works or understanding its fundamentals. They're essentially gambling. Buffett, on the other hand, sticks to industries he knows inside and out, industries where he can accurately assess the risks and opportunities. This includes sectors like insurance, where he understands risk assessment, and consumer brands, where he can evaluate brand strength and consumer behavior. You don't need to know everything about every company or industry. That's impossible. Instead, just focus on what you understand best, the areas where you have genuine expertise and insight. Define your circle of competence, clearly mark its boundaries, and then stay within it. By doing so, you'll avoid most common investing mistakes and significantly increase your chances of long-term success. This simple rule, understanding what you invest in, is your first and most important line of defense against losing money. When you buy a stock, you're buying a piece of a real business, not just a ticker. Think like an owner. Would you buy the whole company and hold it for decades? Focus on strong fundamentals, not short-term price swings. If you wouldn't own the business for years, don't buy the stock. Warren Buffett, one of the most successful investors of all time, has a secret weapon that has fueled his incredible journey in the world of finance. It's a principle that has guided his investment decisions for decades, allowing him to navigate the complexities of the stock market with remarkable skill. It's called the margin of safety, a strategy that revolves around buying stocks of companies that are trading well below their true intrinsic value. This approach is the cornerstone of value investing. Imagine a scenario. If, after careful analysis, you determine that a company's true worth is $100, then you should patiently wait to buy its stock at $70 or even less. This difference is your margin of safety. This financial cushion acts as a protective barrier, shielding you from potential errors in your analysis and also provides a buffer against unexpected market downturns or economic shocks. The key is to identify and find fundamentally great businesses, companies with strong financials and solid long-term prospects. Then, exercise patience, and only make your move when the market offers you the opportunity to buy those businesses at a price significantly below their intrinsic value. By adhering to this principle, you minimize your downside risk and simultaneously maximize your potential for long-term investment returns. Buffett's favorite holding period? Forever. Buy businesses you'd be happy to own for life, ignoring short-term market noise. Let compounding work its magic. Don't interrupt it by constantly trading. Patience turns good investments into great fortunes. The market rewards those who think long-term. Buffett's most famous rule: be fearful when others are greedy, and greedy when others are fearful. When everyone's buying, be cautious. Bubbles burst. When panic hits and prices crash, look for bargains. Buffett made billions buying during crises, when others were selling. Master your emotions. See fear as opportunity. That's how legends are made. Warren Buffett, one of the greatest investors of all time, has distilled his investment philosophy into a few key principles. These aren't just abstract ideas, they're practical guidelines that anyone can follow to improve their investment outcomes. First, know what you invest in. Don't just blindly follow the herd. Understand the business, its financials, and its competitive landscape. Dive deep into the details and ensure you comprehend the company's operations and future prospects. Second, think like an owner. When you buy a stock, you're buying a piece of a business. Consider yourself a partner and evaluate the company as if you were running it yourself. This long-term perspective will guide your decisions. Third, demand a margin of safety. Don't pay too much for an investment, no matter how promising it seems. Always factor in a buffer to protect yourself from unforeseen circumstances and market volatility. Fourth, be patient. Investing is a marathon, not a sprint. Compounding takes time, so don't expect overnight riches. Let your investments grow steadily over the long term. And fifth, go against the crowd. Don't be swayed by popular opinion or market hype. Do your own research and make independent decisions, even if they're unpopular. They're simple, but sticking to them requires discipline and emotional control. It's about resisting the urge to chase quick profits and staying focused on your long-term goals. Make these principles your foundation, and you'll build lasting wealth and peace of mind. It's a journey that demands patience, knowledge, and a commitment to sound investing practices. Thanks for watching. Subscribe for more investing wisdom.